Yeah, this is episode 6 of the series on stock market basics. And in this episode, we'll be looking at how to invest in stock. Yet, if you have been following this video right from the first episode, by now you should have a perfect understanding of how the stock market works, the key players on the stock market, the reasons why you would want to invest in stock. And in this video, we'll discuss how you invest in stocks. So let's get going. There are two ways in which one can invest in the stock of a company. The first one is what we term as the direct investment, and we have the indirect investment. With direct investment, what happens is the investor buys shares directly from the company. The investor approaches the company and then buy the shares from the company directly. So in this case, if an investor is interested in a particular company shares, he engages his investment bankers, and they lead to execute the deal on behalf of the investor. On the other hand, with indirect investment, the investor, instead of buying directly from the firms, contribute to a fund, what we call a collective investment scheme. So there is a fund which pools resources from various investors, and what the fund does is they in turn invest in the stocks of a company. So this is it. The collective investment scheme operates in such a way that people buy shares in that scheme, and then the managers of the scheme in turn buy shares in a company. So what happens is the investor does not own direct shares in the company, but then he owns shares in the collective investment scheme, which in turn holds shares in the company. So it is an indirect form of investment. And the advantage of a collective investment or the indirect investment over the direct investment is the fact that there is an opportunity to diversify your portfolio, and irrespective of the amount of money at the disposal of the investor, he is able to buy as many shares. So with the indirect investment, you are able to do more with just a little fund as compared to the direct investment, because with direct investment you are restricted to just a stock, a company stock, if you do not have a huge amount of money to diversify. So for instance, let's take the scenario of Kelvin, who has $500 he will want to invest in stock, and let's take some key companies stock prices. For instance, Google stock prices was trading at 1,080 USD. Yes, 1,080 USD. What it means is that Kelvin cannot buy the stocks from Google. Let's say Facebook, I think the last time I checked, was trading at 147. Yes, 147 USD. And it will mean that Kelvin will barely get 3 of Facebook stock. And there are times that he won't be able to even get any major company stock, and will have to wait to build up his fund before he can invest in stock. But Kelvin is to use the indirect investment scheme by investing with a fund management firm to buy shares from that firm. What they do is he can use that 500 USD to buy shares from the collective investment scheme, which the collective investment scheme will pool investment from other investors to buy stocks in other companies. So by so doing, this collective investment scheme can own shares in Google, which Kelvin cannot buy or own on his own. They can own shares in Apple, they can own shares in Facebook, they can own shares in major oil companies or any other company that is full of prospect. Yeah, so what it means is that with just 500 USD, Kelvin has been able to diversify his portfolio in such a way that even if one market is failing, which will eventually affect the company stock prices, he's able to fall on the rising of another market and the performance of another company which has its stock. So that is the effect of diversification. Yeah. Most of the times the collective investment scheme are what many people use. An example of collective investment schemes are the mutual fund, we know, the unit trust, and several others. This video is not to talk about collective investment. I will do a separate video which I will discuss collective investment, so do well to check on that video. So for now, you know how you can invest in stock. It's either you do the direct investment or the indirect investment. A recap: with the direct investment, you purchase shares directly from the company by engaging your investment bankers to execute the transaction on your behalf. And with the indirect investment, you contribute to your collective investment scheme, and the scheme managers will in turn buy shares in other companies. So that is it for now. I don't know, you can hit me in the comment section so that we interact more on how to go about it. And also, if you have anything you want me to look at, any topic you think I have not discussed, or any question, you can drop that in the comment section so that we get interactive. If you are yet to subscribe to the channel, please do well to subscribe to the channel, and also like and share our video. Alright, so in the next video I will be discussing share classes. You will get to understand common stock and preference shares.